Hello and welcome to Moneycontrol. You have tuned into IPO Watch, and I'm your host, Nickey Mirchandani. We are here to talk about Kolkata-based hospital chain GPT Healthcare, which has set the price band of its initial public offering in the range of 177 to 186 per share. The issue will be hitting the primary markets from Feb 22 and will close for subscription by Feb 26. The IPO aims to raise roughly around 40 odd crore from the fresh issue. It also plans to raise in funds through OFS by issuing up to 2.61 crore share. With this on the upper price band, the company will be raising in a total of 485 odd crore, and the total market capitalization will roughly stand around that 1,500 crore level. But to know more about the unique offering of this company, the profile, the financials, the strategy, and the way going forward, we've been joined by the director, who's Anurag Tantia, and the group CFO, Atul Tantia. Well, afternoon there, gentlemen.
Good afternoon.
All right, let's start off about the basics. Let's get the basics out of the way. Tell us more about the company, the offering. Much of it is an OFS. It provides an exit opportunity. Talk more about that. It's only 40 odd crore which will be raising in through the fresh issue. How do you intend to utilize that? Give us more details.
Sure. So the offering is, like you said, 2.61 crores approximately OFS from the private equity, Banyan Tree Growth Capital 2 LLC, which had invested in the company in November 2014. They are fully exiting the business because their fund life is over. So they have been with us since for the last 9.5 years. And we will be raising 40 crores of primary money, which will be out of which 30 crores will be used to pay down the debt and the balance for general corporate purposes. We currently have 46 crores of gross debt on the balance sheet, so we will almost become debt free going forward.
So why an OFS of this quantum? Why at this time? Tell us basic details, please. And tell us also more about the company.
Sure. So GPT Healthcare Limited operates a chain of neighborhood tertiary care setup hospitals in the eastern part of the country. We have two hospitals in Calcutta, one in Salt Lake, one in Dum, and another hospital in Tripura in the northeast, and the fourth hospital in Havra, which is the twin city for Calcutta. Across these four hospitals, we have currently 561 beds. These hospitals function as neighborhood tertiary care setups, offering the full bouquet of services to that neighborhood, which is almost a 4 to 5 kilometer radius. We we are setting up more hospitals again in the eastern part of the country, which is quite underpenetrated in terms of good quality healthcare. We have a hospital coming up in Raipur, which will be commissioned this calendar year, and another in Ranchi, which will be commissioned in FY27. We have also identified certain other cities in the eastern part of the country which require good quality healthcare. Cities like Banaras, Patna, Jamshedpur, Guwahati, in which we are scouting for new opportunities for growth as well.
Okay. Why this OFS and why at this time? Can you highlight more details? Because the amount that we're looking at is also almost 440 odd crore, right?
No, so the OFS at the upper end of the price band would be 485 crores, and the total issue size would be 525 crores, including the OFS at the upper end of the price band. Like I said, Banyan Tree, which is the private equity investor, has been with the company for 9.5 years, and they have achieved their fund life. So, as part of the private equity, they were required to return the money to the LPs. So, they are fully exiting the business. There is
Okay.
no effect on the promoters.
Please go ahead. You were talking about the
Yeah,
promoters, right?
yeah. So
How
there
much
is
does the stake come down to? What kind of gains do they make on their investment? Talk more about that a little bit in detail.
sure. So the promoters currently hold about 67.34%. Post-issue, promoters would hold about 65.5% in the company, and they would continue to be invested in the business because that is a segment of this country which is seeing quite a interest in terms of good quality healthcare, and promoters would continue to be investing in the business.
Okay. Let's talk about your financials in that case, specifically EBITDA margins. Provides us some guidance as to how sustainable is the 21-22% and what are the levers going forward.
Sure. So our EBITDA margin is north of 22%, and that is quite a sustainable margin. Some of our hospitals are not mature hospitals, which have been set up in the recent past, like our Havra hospital, which was commissioned about 3 years ago. Once the occupancy there ramps up, we expect EBITDA margin to improve at the network level by almost 100 to 150 basis points and achieve the 24% mark going forward. Our mature hospitals already do an EBITDA margin north of 25%. And so at the network level, we expect to achieve an EBITDA margin closer to 24% going forward.
24% on consolidated basis going forward. Have I got that right?
Correct. Correct.
Okay. That will be achievable by which financial year?
So the Havra hospital is currently at 40-45% occupancy. It should get to the 70% mark in the next 2 to 3 years. So that would be when it would be achieved.
The reason why I'm asking this question is typically to understand the margin profile, which seems to be a little lower as compared to some of your listed peers like Jupiter Lifeline, which is a recently listed entity, Yatharth Hospital, KIMS, you have Global Healthcare. All of them seem to be having an EBITDA margin which is slightly better than yours. What explains this underperformance? Sure, 24% is the level that we are now looking at on consolidated basis, maybe by the end of the financial year FY25, if I got that right. But what helps understand the underperformance?
So it is more of a market dynamic. We are operating in the eastern part of the country, which is, as Atul highlighted earlier, underpenetrated from a healthcare point of view. The overall ARPOB levels in the region are at around the 32,000 mark compared to Jupiter or other listed players having a much higher ARPOB. That explains a lot of the EBITDA margin, the slight economization of the EBITDA margin which we end up working at. Uh, that being said, we are at par with our Asian peers in terms of our pricing and in terms of our ARPOB. And that's an EBITDA margin which we are very comfortable with, and we can build upon that in the coming years.
Okay, let's talk about the region that you're operating in Eastern India, which apparently is underpenetrated. At this point of time, do you intend to diversify your geography, if at all? How do you intend to scale up to 24%? What are going to be the levers essentially which will drive that growth? And for the next 3 years, how sustainable these margins will be?
So, in terms, as I said earlier, we are an Eastern India focused company, and we are looking at expanding our presence in other cities of Eastern India. We are coming up with a hospital in Raipur and at Ranchi. With these hospitals coming up, there will definitely be a hit on the EBITDA margin for a initial period. But that being said, our latest hospitals of Havra and Damdam, we broke even in 10 months and 8 months respectively, which is a very fast break even considering the asset heavy nature of the business. We are very hopeful that the new hospitals in Ranchi and Raipur will also break in faster basis our neighborhood structure of business. Uh, in terms of apart from this, we are also looking at other organic opportunities across the eastern segment in cities like Guwahati, Jamshedpur, Patna.
Okay, I think I just missed on to your point where you're explaining that the margins are going to be impacted in the near term due to the launch of a particular. Could you just highlight that? I think I kind of missed on what you were trying to explain here.
Sure. So hospitals are asset intensive businesses, and they generally end up taking almost 3 years to break even on an EBITDA basis. But that being said, our latest hospital of Havra broke even in 10 months at an EBITDA level. Our hospital in Damdam also broke even in 8 months at an EBITDA level. So we tend to place our hospitals in these densely populated areas, which tend to help us in breaking even faster. Our hospitals in Ranchi and Raipur are new markets for us, and we are mindful of that. But that being said, we expect the EBITDA break-even to be around the 13, 14-month mark in these locations.
Okay. By the end of the financial year, can someone expect a moderation in terms of your margin profile for the quarter, for the, rather just say the second half of the financial year, before it finally scales up to 24% mark? Can you help me understand this a little better?
Sure. So in terms of FY24, the margins will not be affected in terms of the new hospitals in Raipur or Ranchi because Raipur will be only commissioned in FY25. We expect the Raipur hospital to be commissioned in the later half of this calendar year. This will slightly affect the margins at the network level, but having said that, the Havra occupancy is also ramping up quite well. So we don't expect a major dip in the margins for the full year FY25 as well.
Help me understand the revenue CAGR for the last 4 years, typically, between the period of 20 to 24. What was the rate at which industry grew and what was the rate at which the company grew?
So we have grown at a revenue CAGR of almost 21%, which is quite
Okay.
a healthy CAGR over the last 3 years. The industry has also grown in tandem with that. Some specific companies who have set up new facilities would have grown slightly higher, but overall the industry has grown around the same mark.
Okay, the reason why I was asking this question was because the healthcare delivery market is now expected to grow at a CAGR between 9 to 11% from FY24 to 28, which
Correct.
means from the industry basis also the growth is expected to slow down. A, is that true? And if yes, why? And then second, do you intend to match up to the levels of industry or perhaps even outperform it? Give me a fair bit of assessment there.
Sure. So our mature assets will grow around the same mark in terms of 9% or 10 odd percent in terms of the growth going forward. But the assets which are still not mature, like Havra and Agartala, would exceed that. So we expect them to beat the mark, which will ensure that the network level growth would be higher than the industry for us.
And how, on the consolidated basis, gentlemen, how will the growth shape up in terms of the CAGR, top line CAGR for the next 4 years or so?
So the with the addition of new facilities, the growth should be the same as what we have achieved in the last couple of years. We expect that momentum to be maintained going forward as well.
Sorry, I missed on that. Could you repeat that for me?
Yeah, so we expect the momentum of growth which we have achieved in the last 3 years to be maintained.
21%.
Yeah, 20 odd percent, sub 20% to be maintained going forward as well. This obviously would ensure would be with the addition of new assets that we have given to the investors in terms of Raipur, Ranchi, and other inorganic opportunities that we are pursuing.
Okay. So you achieved a growth of sub 20% is what you're saying for the last 3 years, which is the 18-90% kind of a number that we're looking at.
Correct. So we have achieved almost 19 odd percent growth over the last 3 years, which is what we are expecting to grow as well, which would be almost double of what, like you said, the healthcare delivery market is expected to grow at 9 to 11%. So we would be kind of much better than that.
And what helps you can you help us understand that where will the outperformance come in from? Which are the specialty divisions per se which you will add, or what kind of strategy that will stand out, which will lead to this incremental set of top line growth, which will be almost double as compared to the industry standards? Levers essentially.
So we are adding new facilities, like we said earlier, in terms of Raipur and Ranchi, which would be allowing us to achieve that kind of growth. We are, in terms of specialties, we are adding a radiation oncology setup in our Agartala hospital. We are obviously looking at tweaking the specialty mix at our existing hospitals to achieve the kind of growth that we are speaking about.
Okay. That's pretty curt there, but let's talk about your expansion plans. The company intends to focus on attracting medical value travelers through their expansion plans. Help us understand more on this segment. What kind of capex has been earmarked for it? What kind of percent revenue contribution can be targeted from this? How scalable is this business? Tell us more about it.
Sure. So the two new hospitals which are coming up are in Raipur, which will be commissioned by FY25, and the one in Ranchi, which will be commissioned by FY27. These hospitals at their peak would be contributing almost 15 to 20% of the overall group revenue. As I said, we work on a ARPOB level which is at par with our regional peers and which is almost at a 20% discount compared to our national peers. So yes, we do attract medical value travelers from that perspective, that we are giving healthcare or making healthcare accessible to people in the middle income segment of the population. In terms of the newer hospitals, as again highlighted earlier, these hospitals will be located in densely populated areas, and we hope to make healthcare accessible by placing these multi-speciality tertiary care hospitals closer to the homes of the people, and not expecting them to travel almost 45 minutes, 50 minutes away to the closest tertiary care hospital.
Okay, gentlemen, you said 27 and 28, Ranchi and Raipur hospital, that's when they're going to be commenced, right? When they're going to be expected to show into your financials? You've also given a percent to it, but when they translate into your financials, by which financial year?
So Raipur will be commissioned by FY25 and Ranchi by FY27. We expect Raipur to end up giving almost 20% revenues by FY27 and Ranchi by FY29.
Okay, all right. Let's talk about your bed occupancy, which stands at 58.9% in FY23 and stood at nearly 60% in the first 6 months of the financial year. What can be expected going forward? Because it seems to be a little on the lower side as compared to some of your listed peers. I'm sure there is also new addition to it. So I'm sure you're going to highlight as to how much this number is scalable and by when.
Sure.
So the bed occupancy, yes, we are at the 60% mark, and that's primarily due to the overhang of the new hospital in Howrah, which is currently operating at around the 45% occupancy. We expect that hospital to reach an optimal occupancy level of around 70% in the next 2 years. Overall, we are hopeful that the amalgamated occupancy will be at around 70% mark in the next 2.5 years.
Okay. Gentlemen, I think most of the people around the street would want to understand one thing. How different is your company as compared to any of the listed entity which is available there in the markets? What's your uniqueness to the business? How do you stand out? Tell us more about your USP in that case.
Sure. So I think that we will be the only Eastern India-based healthcare chain that will be listed, and there's a lot of interest because that is an underpenetrated segment of the society or the country with dearth of good quality healthcare. Investors who are looking at that part of the country to invest in good quality healthcare assets would be attracted to this issue. And we have a good control on the numbers. We are offering good return ratios. So our ROC and ROE has been north of 25% historically, and we expect to maintain that as well. We have a good dividend policy as well. We are, in terms of our payer mix, 95% of our patients are cash and insurance, which leads to negative working capital cycle for us, and which also leads to a good cash flow to EBITDA conversion north of 80%, which is one of the best in the industry.
Few points essentially that you've dwelled on. I think, gentlemen, we're just going to leave it at that. And thank you so much for taking out the time and having this conversation here with us. With this, it's a wrap, and goodbye from the entire team who puts this piece together for you. Thank you so much for watching.
Thank you.
Thank you.